Hey there, Dave Keller here with Market Misbehavior. This week is a pretty heavy earnings week, and in particular, two stocks of interest reported earnings. Netflix earlier in the week on Tuesday, and then AT&T reporting on Thursday. And when you think of Netflix versus AT&T, you think of them as probably two very different companies. However, all eyes are on streaming content and streaming subscriptions, and that is the story of the current streaming wars between Netflix and AT&T's HBO Max. So today we're talking about the streaming wars from a technical perspective. All right, so we're going to look at two stocks in particular that are part of what I call the streaming wars, AT&T and Netflix. Now, Netflix we think of as a subscription business, right? That's a video sharing or video content business. And it's all about them being able to grow their subscribers and monetizing that. AT&T you think of as a lot of different components to their business. However, what we're seeing this week is certainly a reaction, particularly to the HBO Max component of their business and their ability to compete in streaming with other providers like Netflix and others. So far, what we saw this week from earnings releases and updates on those subscriptions, a vote of confidence in AT&T, a vote of less confidence in Netflix's ability to continue to grow their subscribers. Before we get to the charts, if this sort of thinking about price behavior relative to news flow and earnings is of interest to you, I hope you'll hit subscribe. It'd be great to have you join us along this journey on the Market Misbehavior channel. Also, give our video a like if you could. We'd certainly appreciate it. Below the video, as you're watching, as you hear my comments, we look at the charts together, let me know what you think. Between these two, AT&T and Netflix, which do you think gives us the best opportunity over the next 3 to 6 months, and why? Let's get to the charts. All right, so we're going to start looking at a chart of Netflix. And again, I'm often asked around earnings, does it make sense to look at charts? Because it's not, what's happening is not driven by technical inputs, it's driven by earnings, right? It's driven by the fundamentals. I would argue that in this sort of environment with companies reporting earnings, it is absolutely an ideal time to look at charts because charts tell you the investor sentiment, the investor psychology leading up to the earnings release. They show you how investors are treating the stock after the earnings release. You can see the supply and demand going up until the announcement. You can see the supply and demand after. You can see when people are excited, nervous, desperate, euphoric, panicked, optimistic, pessimistic. All of that is reflected on the stock price. So I would argue it's always, I'm very biased to tell you it's always a good time to look at charts, but I think around earnings, it can be really, really helpful because once earnings come out and once a company like Netflix disappoints or when a company like AT&T surprises, it's all about what next. And that's where the charts can be really, really valuable. So let's start by looking at the chart of Netflix. And I've drawn this pink rectangle to illustrate really what your experience has been being a Netflix shareholder for the last 8 months. And the answer is not much. If you look at Netflix from July of 2020 and you look at where we're at now, we're literally at the same place. We started the 4th of July weekend, ended right about where we're at right now here, 8 or 9 months later. So the reality is, while the rest of the market has been going higher for the most part, and you can tell that by the fact that the relative strength line is sloping consistently lower, it shows you that Netflix has essentially been what you call dead money, sort of a wash. You really haven't gained or lost anything. But in an environment where most stocks are appreciating, it's kind of a painful thing to hold. It's something that's certainly not adding to your ability to outperform the rest of the market. So what happened leading up to this earnings announcement? You can see that Netflix was essentially range bound from around 460, 470 on the lower end, about 560 to 580 on the upper end. And that was the peak from July. We then came back down and tested around 470 there at late July. And then from there, we literally have just bounced within that range. That's why I drew the triangle here. Now, what's interesting is when a stock has had a run higher and then goes sideways, the 200-day moving average actually gets closer and closer and closer, right? Because as the trend goes up, the moving average is lagging behind. But once the price sort of stabilizes, the moving average kind of comes up and slowly meets the price. So the stock can break down through its 200-day, not because it's going down, but just because it's not going up anymore. And the long-term trend is catching up to the short-term weakness. And that's sort of what we've seen in the last 6 to 8 weeks with Netflix. Netflix first tested its 200-day moving average back here in early March, tested it again in mid-March, again in late March. And then once again, we've now closed below it 2 days this week. This was the gap down when they reported earnings Tuesday into Wednesday and Thursday. So the question now is, what next? Well, overall, when a stock is in a range bound situation, the general consensus, the general technical approach is the range is in place until proven otherwise. So at some point, Netflix gets above 580 with authority, or it gets below 460 with authority. And whichever way that momentum breaks, that's most likely the direction where it's going to go next. Because the idea is essentially the stock has been in an equilibrium for the last 8 months. And until there's a catalyst, until there's something that compels an influx of new buyers or a rash of selling, some change of some sort, then the price overall sideways. It's worth noting that they actually announced a buyback during earnings as well. So even with that, the stock was down pretty good. So overall, stock number one, Netflix, essentially has gone nowhere, and the earnings miss has caused it to gap below its 200-day moving average. Now we're testing some swing lows here from March. So I think getting below 500 would be the next indication that there's going to be more weakness. Getting below the 200-day was step one. Getting below 500, the swing low would be step three. Getting below 460, which would be the low of that range, I think would indicate a much higher potential for much further downside, but have to do that first. Now let's look at AT&T, and a couple things to note here. Number one, basically AT&T, you can see while Netflix gapped lower with a subscriber miss, AT&T actually gapped higher because of positive news on subscriptions to HBO Max. And again, regardless, it's a lot of promotions, it appears, that are fueling those subscriptions, but overall they're adding people, and that's what investors appear to be keyed in on. What's interesting is with this gap higher, it's now putting AT&T right at the December 2020 highs, right? So we hit a peak in December, came down and essentially was range bound for the first couple months of 2021, then broke out of that base to the upside, pulled back to the 50-day, and now gapping up and hitting that level. So just like Netflix is testing support, you want to see if it validates that weakness by breaking down. AT&T is testing resistance. You want to see if it's able to follow through on this gap higher, push above its previous highs. Right now, it's right about where it closed on that December peak, right around 3150. Like to see it get above there, ideally above 32, which would take us above that high from early December. Now, it's worth noting that the relative strength on both of these stocks has been pretty weak. Netflix has really rotated lower in the last 6 to 8 months because it had a nice run into the fourth quarter before sort of disappointing on a relative basis, sideways price, underperforming relative strength. AT&T has actually been underperforming fairly consistently since the March low. Essentially, if you look at what happened, rallied pretty good out of the March 2020 low, but then from there it petered out. And when stocks peaked in June and pulled back, most of the market actually continued higher and higher, made new highs, and pushed on to where we're at now. AT&T has really gone nowhere. Now, your chart of AT&T could look a little different depending on where you're looking at it. And the reason is because of how you adjust the data. It's kind of a good time to mention that. So, when normally what we would do, and there are different philosophies on this, but I know what we would do on stock charts is when, normally when you bring up a stock, you're adjusting the data, which means every time a stock pays a dividend, you have to take some out of the price, and that comes out, and that's paid out as a cash dividend. As a result, you have these little artificial drops in price as the company's paying a dividend every quarter, every month, or whatever it is. With a stock like AT&T, that's a big dividend payer, the dividend yield is around 6.6% right now. It's such a big dividend that if you adjust the data, it actually makes the historical prices look a lot different. So here's the unadjusted price of AT&T, and you can see right now we're actually above the December high and even above the June 2020 high. But when you take out those adjustments and recognize the fact that you've given up price gains because of the dividend payout, you can see that we're still testing those resistance levels. So it's important to remember to unadjust the data, make sure you're looking at pure price and not adjusting for dividends when you're looking at a stock like AT&T. It really comes into play with big dividend payers like an AT&T, Verizon, REITs, things like that. So overall, you have stock number one, Netflix, testing support and the line in the sand to see if it confirms a downside break of that range. I think with AT&T, you're testing the upper end of that resistance. So given those two, what makes more sense than the others? We're going to actually look at the two of them together. This is using what's called a gallery view on stock charts, where we're looking at AT&T and Netflix together side by side. Looking at the daily view, you can see over the last year the difference between the two. Look at how AT&T is gapping up, breaking out of this base. And again, if we unadjust it, it's going to look a little different. So let's do that right here. There we go. No, no, there we go. So here we can see the the unadjusted data, and you can see how it's still testing resistance. Look at the difference there between AT&T and then Netflix, which is gapped down on earnings, now testing support, breaking down through its 200-day moving average. So just simply from the reaction to earnings and where it is in the cycle, testing the upper end and a potential breakout, the lower end, a potential breakdown, AT&T certainly appears to be in a better potential spot. It'd be interesting to see if the relative strength on AT&T could improve as well. The weekly view actually tells an interesting story as well, because you can see the run that Netflix has had over the last 5 years, but you can see again the sideways trend. This is the 200-day moving average, really the 40-week moving average in blue, as opposed to AT&T, which is really coming off of a relatively weak level and rotating back to the upside. So it appears with a higher yielding stock of AT&T, you have something that's potentially emerging from a base to the upside. Netflix that is testing support, and the lower end of the range testing a downside move. So that's my technical breakdown of AT&T versus Netflix. Again, AT&T has a dividend component, has a lot of other businesses other than HBO Max, but I would argue right now it is a subscriber battle. It's all about the subscriptions between Netflix and their subscription model and AT&T's ability to grow HBO Max. Regardless of how much money is being made from these subscriptions, it's all about that top line number. And overall, what the charts show you this week is definitely a vote of confidence in AT&T's ability to grow HBO Max and less confidence in Netflix's ability to continue to grow at the pace that it has in terms of subscribers. As we spoke about, though, it's all about the follow-through, I would argue. With AT&T, can it push through upside resistance, follow through, and break out of a base, which has been coming for a long time, arguably? On Netflix's side, does it finally break through downside after breaking down through its 200-day moving average? Does it continue down and break down below this range that it's been in for 6 to 8 months? Those follow-throughs, that's what you'd be looking for right now to understand the next leg, higher or lower for AT&T and Netflix. If this sort of thinking about price behavior relative to earnings releases and news flow and other fundamental data is of interest to you, I hope you'll subscribe to my channel. It'd be great to have you along this journey with me. Also, give this video a like if you could. I'd certainly appreciate it. And put a comment below the video. Which between these two, AT&T or Netflix, which do you think has a better opportunity right now from a technical perspective, and why? Let me know. Love to hear from you. From all of us here at Market Misbehavior, I'm Dave Keller. Be well, stay safe. Talk to you again soon.